So Jerry, you're on 2 computers, just so you're aware. I think the other one is there's no display.
No,
And there's one.
That was my second attempt at connectivity this morning. This is my third attempt.
God.
Morning, Mel.
Morning. This Scott.
It is. How are you doing today?
Pretty good. Are you local right now, or are you out of state?
Yeah, I'm back in California for this week anyway.
Oh, okay, cool.
Next Saturday.
There we go. Sean must be here. Sean, I can't hear you.
I don't think his audio is. There he is.
Yeah, still no audio, Sean. Sean, we can't hear you. Sean, do you think if you log out and log back in, you would be able to? Okay. Okay, so I think Jerry, Sean is ready to co-host, so you can start your session whenever you're ready.
Okay, real good. So once again, welcome to St. Killian's Church VITA session. This is session number 2. Last week we started it off. You should keep in mind that on the 20th of November, we will have a third session, but that fourth session is going to be a couple weeks after that because we'll take that break for the Thanksgiving holiday. And so with that, we'll go ahead and advance to our next slide. And these are the objectives. We're going to talk, do the welcome like we did before. We'll talk a little bit about some of the PUDs that we introduced to YouTube last week. We'll have an opportunity to go through a scenario that was emailed to you a couple days ago. We'll go through that. That's the David and Ali win scenario. We'll talk about selected topics, and then we'll really jump into the Schedule A, C, and D. A little bit about adjustments to income, and again, a tax return exercise. And what we'll do each week, we'll go through one return. It could be a basic one. It could be a little bit more advanced, but every week we want to have an opportunity to run through at least one return. And you should keep in mind that that return will be sent to the St. Killian leadership about 3 days out. So if you want to have an opportunity to work on it, you can. And there will be check figures at the back of that document. So when you get these tax return scenarios, you should check for the what is called the check numbers. Basically, those are numbers. For example, I give you the taxable income, I give you the refund, something like that. All right, let's go to the next slide. Same as last week, we'll go till noon. We'll take a break at 9:50 and 10:50, give you a chance to recharge. And then, yes, if you do have any questions, please type them in the chat. I'll do my best to answer them. If we can't answer your question on the Zoom call, then what I'll do is I'll look it up and I'll provide that either to the leadership or next Saturday. All right. I will give an opportunity, Mel, if you want. Do you want to talk about your team?
Okay. Hey, good morning, everyone. This is Mel St. Killian. Again, thank you for attending the training session. For if you're volunteering in St. Killian, we have a few new volunteers. We will have volunteer orientation. I will talk with Sean about the details, and he will send the email. Sean is our training coordinator, and thank you so much for attending. I think Fred and some of the group is out of commission this Saturday due to prior engagement. So again, thank you. Back to you, Jerry.
Okay, and I'll be the instructor for the remaining 5 sessions going into December. If you don't have a schedule, you should check with Sean. He's the training coordinator, and there's a course schedule that was published a number of weeks ago. All right, let's go to our next slide. All right, just a few things on our list of publications, forms, and instructions. There are many that we use in the VITA program, and if you are new or newer to VITA, you've got a few go-to documents, and those go-to documents include the IRS publication 4012, that's the Volunteer Resource Guide, and that particular guide has been released. You can find it on the IRS website, and my understanding is, Sean, if I read the emails correctly, the hard copies are going out soon. And then another publication that you probably are familiar with if you're a returning volunteer is that publication 17. Do keep in mind these publications will answer the vast majority of your questions, but sometimes you're going to have to dig into yet another IRS publication. But those are your 2 go-to documents. And then, as I mentioned last week, another document that I use a lot is the IRS publication 525, and that's discusses taxable and non-taxable income. It's a really good publication, especially when you get those strange or oddball questions about is this taxable? And for example, you might have someone who has won a court settlement, and with a court settlement, you have to look at the court instrument. You have to determine if it's taxable, if it's non-taxable, or if it's taxable in part. All right, and so I think that pretty much takes care of that. Before you go to the next screen, just informational, the draft schedule 1040 and schedule 1, 2, and 3, they have been published. You can find that on the IRS website. And so that's a good thing. You can start reviewing those documents to prepare yourself for additional training and the season. All right, how about the next slide? And then just a few things. If you've been on TaxSlayer Pro, i.e. the Practice Lab, 2020, it was still there and it will still be there. 2021, I went into it a few days ago. It is, I'll call it hung or posted in the Practice Lab. But as of a few days ago, the program was clunky. And what I mean by that is I was attempting to enter data for a W-2 to practice, and the program would not save the W-2 data. So hopefully it's less clunky today, and by next week it should be much less clunkier. So what that means is the software guys and gals they continue to tweak the 2021 software. And then, as I mentioned last week, if you have not gone into the tutorials in the practice lab or those practice return solutions in the practice lab, you might want to give it an opportunity. You might want to try it out, because what it is it gives you additional training or refresher training, and it can only benefit you. And if you're new, then you probably want to stick with, as I mentioned before, the tutorials in section 4, and then those practice returns, ignoring the married filing separate practice return, because in VITA, in California, we do not prepare married filing separate returns. And then, just like the information I sent out on the David and Ollie Wynn, the practice returns, they do have check figures, which guide you along to the correct answer that you come to after you enter the data in the software. All right, I'm going to hesitate for a moment and see if anybody has a question. Sean, any chats that we want to address? The question is, some people asked if they should create an account. My recommendation is if you're going to become a VITA volunteer and you do not have an account, you want to establish an account to utilize the practice lab. And then you also want to create an account to access what are called the certifications. And then I always recommend, if you're not good with passwords, and I am not, then you want to jot that down somewhere where you can go back and find those passwords. But yes, create an account. And you should keep in mind, when you create an account, you're going to be asked information: your name, your email address, your telephone number, and your mailing address. What that means is the government contractor for the IRS is collecting data for the IRS. As I mentioned before, you will not be contacted to sell you some insurance or shampoo. You might be contacted for a survey, but that's it. So again, you've got to register to use the practice lab, and you got to register to access certifications. Okay, how about the next slide? All right, so here's some selected topics that you're going to be seeing at the VITA site. And one of the big ones is Social Security benefits. And as most of you may know, Social Security benefits, you have to, of course, pay into Social Security to qualify. And the rule is you've got to pay in 40 qualifying quarters, which essentially is 10 years. And most individuals, when you think of Social Security, they're going to be drawing their benefits at age 65. However, you're going to meet people, for example, I'm a former government employee, federal government employee, and I was eligible for Social Security at the age of 57. So you'll find people who are eligible younger than 65. For people born after 1960, those Social Security benefits, they'll be able to draw them at age 67. That's the full retirement age. And then, of course, you have other individuals who decide to take what is called actually reduced benefits, and so they can sign up for Social Security at age 62. But the bottom line is, the people on Social Security, they will be issued a SSA 1099, and that will explain the amount of benefits that they receive. It will also explain any Medicare that they've paid. Medicare, of course, you pay premiums. And it's my understanding, I've actually talked to a few people over the years. I thought Medicare was a requirement, and I'm not aware of any regulation or statute that requires individuals to go on Medicare. It's something you choose to do, you pay the premiums, and it's reflected on the SSA 1099. Here's a great publication, because you will be working with Social Security recipients. That's an IRS publication, 915. It has a number of scenarios. It's a good publication. It talks about anything you want to know about reporting Social Security benefits. And then you might have what is called railroad retirement benefits, and that's for folks who've worked on the railroad. They've got their own system. it's kind of like if you go to the United States, there are many different types of retirement programs. And I'll use an example. In the state of California, there's a thing called the California State Teachers Retirement. And so you might bump into someone who is was a teacher for many years. They never paid into Social Security, which means they're not eligible for Social Security. So there's different programs. And the railroad retirement folks, it's the same concept. They don't get Social Security, they get railroad retirement benefits, which is like Social Security. And then something that you might see from time to time, I remember the first time I saw this, I looked at an AARP volunteer and said, "What are you talking about?" And what happened is someone had applied for Social Security benefits, and it took a number of, I think it took a number of years for Social Security to adjudicate the case. And then what happened, a lump sum payment was made, which means it covers a couple of 2 or maybe even 3 years. In that case, there's a special treatment, and your go-to document for that, other than the 915 that we just talked about, is the publication 4012, which shows you how to treat that lump sum payment. I see that in my VITA time. I think I've seen that maybe 3 or 4 times. So you may see that, and if you do, you should go directly to page Delta 47 in your publication 4012, and it'll guide you through it. Okay, retirement income. We see a lot of this. I saw a lot of this at St. Killian's last year. I see a lot of this at the site that I work at, Garden Grove. And your controlling document for that is an information return called the 1099-R. And that 1099-R is going to cover a lot of different things, particularly 401k distributions. When you hear 401k, it simply means Internal Revenue Code Section 401, and then I think it's subsection K. You have also 403Bs, which is a type of retirement plan, 457s. I'm under a retirement plan with the federal government called a 414, and so there are different types. But again, all of that information is going to be shown on a 1099-R. And then this is something that you may see. I've seen this every season at least one time, where someone who's retired, they have what is called cost or basis in their pension, which means they've made contributions. And probably the most spectacular one I saw was a number of years ago, where a guy came into a VITA site. He was receiving his pension, and he insisted that he had contributed $80,000 to his pension. I said, okay, well, if that's the case, then you have what is called basis in your pension. And so what that means is when you recover that basis, that is a non-taxable event. And so what you need to do, typically, you're going to follow what is called the Simplified Method, which means when you go to page Delta 37, you're going to report the amount of the distribution, and then you're going to report the amount of, you're going to report other data, i.e. whether it is a joint pension or a single pension, the ages of the taxpayer, and of course how many payments they received during the year. But the bottom line is what you're doing with the Simplified Method, you're recovering part of that basis over a period of time. And what we are going to do, we're not going to do that today. I don't think we're going to have time to do that today, but as we go through our class, we're going to have a very detailed scenario, a tax scenario, and we will show you that Simplified Method and other things. And then you might bump into this. I've seen this maybe 3 or 4 times, a qualified charitable distribution. And so what that means is you've got a taxpayer who decides that they want to take money out of one of their plans and directly contribute it to a charitable organization. And so what that means is they're not going to pay income tax on that distribution, because it's going directly to a qualified charitable organization. And that's described on page Delta 42. And then, of course, you have to meet an age requirement, which is stated on the slide deck. You've got to be 70 and a half at the time of the distribution. And then other income, you see this, I see this a lot at the site that I work at, and I don't know if it's going to be the case for 2021, tax year 2021, but a lot of people, they borrow money, and typically they'll borrow money on a credit card, and then what happens, they are either unable or in some cases unwilling to pay that money back. And then what happens is there's a cancellation of debt. The credit card company, which is an incorporated entity, they'll send out a document, a couple of documents to the taxpayer. Obviously, they'll demand payment, and then eventually the corporation will decide that this is a worthless debt, and they'll issue a 1099-C as in Charlie, which is cancellation of debt. And then, of course, on the corporate return, they'll obviously take a tax benefit. So what happens is when someone comes in with that, they may tell you, hey, I couldn't pay my credit card. I didn't pay my credit card. I got one of these, a 1099-C. And then you'll ask a few follow-up questions. Typically what will happen is the individual will not be insolvent, or the individual will not be in bankruptcy. If you're insolvent or if you're in bankruptcy and you get that 1099-C, you get the cancellation, then you're not going to be liable to report that. But this is important. When people say that they are insolvent, what the definition of that means is they have more liabilities than they have assets. And so there's an insolvency worksheet in the publication 4012. You want to determine if that's the case when they have the cancellation of debt. Bankruptcy, that's pretty easier. Obviously, they're going to go into a bankruptcy court, which is a federal court. They're going to file a petition for all of their debt or some of their debt to go away. And in that particular case, that cancellation may not be reported as a taxable amount. So again, you do see that from time to time. Typically, it's credit card. And so again, you ask those questions. Another thing that we're going to see this year, I've seen it probably once a season for a number of years, is what is called qualified principal residence indebtedness. And so what that means is someone buys a home. Typically, when people buy a home, they also get a loan. So you think of it mechanically. You borrow money, and the bank says, okay, here's your loan. Now, of course, you're going to use it to purchase a home, and then eventually you have some type of financial issues. And a lot of people figure, well, if I have financial issues, I'll give my house back to the bank or let the bank foreclose. And that happens from time to time. Well, if you have that, then you may have what is called cancellation of debt. But then there's Congress came up with this qualified principal residence indebtedness. So if you meet certain requirements, then you may not have to pay income tax on that cancellation of debt. This is a little bit more involved. I will be very frank with you. If you're brand new or if you're newer to VITA, you're going to have to read up in publication 4012, and then you're going to have to conduct that interview with the taxpayer to determine if they do indeed have cancellation of debt. And typically, there's going to be what is called an information return issued to the taxpayer, and that would be that 1099-C, cancellation of debt, or 1099-A, which is acquisition or abandonment. And sometimes you will have abandonment and the entity, i.e. the bank, will issue the 1099-C. Sometimes you have cancellation, the bank will issue the 1099-A. I've seen it both ways, and you may see it both ways, but I think it's really important to detailed interview, review that publication 4012. I will tell you what I do at my site, as I'm a site coordinator at my site. I will have my most experienced volunteers. I'll match them up with a junior volunteer when we have this particular topic, and they'll be able to tackle it. But I would not give this particular topic to a new or a newer volunteer. It doesn't mean they can't do it, but I will match them up with someone who's senior, who's done this before. And then an excellent publication, if you want to read about any type of cancellation of debt, whether it's credit card, whether it's secured or unsecured, is that IRS publication 4681. And that's typically revised every year, every other year. And it talks about anything that you want to know, to include worksheets on insolvency when we're talking about cancellation of debt. And if you've ever gone through a foreclosure, or if you haven't paid your credit card, it's financially traumatic for people. And so when taxpayers explain this to you, most likely they're going to get pretty emotional. They may get sad, but the thing is, you can work through it because you've got the tools in the 4012 or in that publication 4681. So again, I'll leave you with this. When you're talking about cancellation of debt, you do have to determine whether or not they're in bankruptcy or they have what is called, or if they are insolvent. So insolvency, it simply means negative net worth. And so what that means is You're going to go through that worksheet to determine their assets and their liabilities. If they do not understand what an asset or a liability is, and you can give them some examples. So, for example, if you own your home, if you're entitled to your home, that's an asset. If you've got a mortgage on your home for $200,000, that's a liability. And so let's say your home is worth, let's say $700,000, and you've got a loan of $200,000. That simply means that you have equity in your home of $500,000. And so your automobile is an asset, your refrigerator is an asset, your clothing is an asset, and of course your automobile loan is a liability, your 401k balance is an asset, and all of those add up again to assets or liabilities. So you simply go through that calculation. And you don't have to be an accountant to do that. If the taxpayer gives you all of the data, then you're able to determine whether or not they are insolvent. Okay, I'll hesitate for a moment and see if anybody has any questions. Sean, any questions from the crowd? The question is, how often do we see this? I can only give you my experience. I have seen it maybe once or twice a season. We're talking about qualified principal residence indebtedness. As far as credit card, I've seen this every single year in the VITA program, maybe 5, 10, 20 times. So you'll see cancellation of debt for a credit card many times. And I've said this before, and I will be judgmental here. When people come to you with a credit card cancellation, it doesn't mean they're a bad person. It simply means they have cancellation of debt. And so what that means is we're going to help them as best we can. Some people get into a financial situation and they can't get out of it. But again, it doesn't make them a bad person. It just means they can't make that payment at that particular time. And again, this is a sensitive topic. People get embarrassed. So you just help them out as best you can and then calculate what's taxable, what's not taxable. All right, Sean, any other questions?
No other questions.
All right. Oh, you're back.
I was always there. It just didn't work.
Hey, a quick question. Sean, do you know if those hard copy publication 4012s are being distributed?
We're going to start distributing them to the St. Killian volunteers on Monday. We don't have enough for everybody on the training, but each site coordinator should provide them for the people at their site.
Gotcha. And then once again, the publication 4012 for tax year 2021 has been published. So if you like the electronic version, you can go to the IRS website and you can access that. Okay, let's go to the next slide. Okay, a couple of the topics, and we mentioned this last week about prizes and awards and jury pay. But let's go ahead and kind of refresh our memories. And so you're not going to be internal revenue agents, and you're probably not going to be CPAs, and you're probably not going to be attorneys unless you're one already. But you do remember when someone comes to you with a topic that is in scope, you're going to see a lot of unusual situations that are in scope. So all you got to remember is, and this is how I do it, I'll look at the item, I'll make a determination that, well, I got to do some additional research, but everything is included in gross income unless it's excluded. And examples of exclusions would be if you receive a gift as a recipient, if you borrow money, you have a loan and you're the borrower, those are examples of exclusions. And so typically what you're going to do, you're going to look at the fact pattern. It could be a very simple one, or it might be a little bit involved. So the first thing you want to determine is it within scope? If it's in scope, then of course you want to determine, all right, what's taxable, what's not taxable. So when you're talking about prizes and awards, there are many different types of prizes and awards. And so for example, I think I won a couple of prizes over my lifetime, maybe 20 bucks or 50 bucks or something like that. And so what I know is generally the prices that we're going to bump into are going to be taxable. And generally when you receive an award, it's going to be a taxable amount. But again, I would always ask the person, I'm a really inquisitive guy. I ask lots of questions. And when you ask lots of questions and you guide the conversation, then typically you're going to get the answer. But you want to determine what it is. sometimes people will show you what is called an information return, a 1099 MISC, and they say, I got this. Then my follow-up question is, okay, understood. What is it for? Did you enter a contest? Did you turn somebody into the police department because they were vandalizing automobiles and got a reward? What is this? So that's important. Just do the follow-up. And remember, everything is included in gross income unless otherwise excluded. And so when you go to the form 1099 MISC, what that means is that's miscellaneous income. Generally, well, be careful here. Sometimes MISC is not part of gross receipts on the Schedule C. So you want to determine what is it for. So I ask people, what did you do to receive this 1099 MISC? And typically, again, a prize or an award. Now, this is what you can do. And if I remember correctly, this is in scope. I've seen this a number of times where someone wins something. I'll use an example of my buddy and his wife. So we were sitting around one day with my buddy, and his wife came home and she announced that she had won some type of entertainment center that had a television built in. And of course, I put on my tax hat and thinking, oh, that's interesting. So did they give you a 1099 MISC? And she said, yes, I have it right here. I said, okay, well, let's do this. Let's call down to some store to determine what is the fair market value or the selling price of this particular entertainment center right now. Same make, same model, same year. So we did that, and the fair market value or the amount that the item was for sale was less than the 1099. And so I offered my opinion to my buddy's wife. I said, you have two choices. One, you can report what is shown on the 1099 MISC, or that lower amount, i.e. the fair market value. And she goes, well, will I get a letter from the IRS? I said, you may, but so what? You get a letter, you respond if you have to. But again, that's something you can do. I've done that myself. I've won some small awards, and I report the fair market value. But if you're going to do that, this is very important. When you receive, and typically we're talking about tangible personal property, and then of course you get a 1099 MISC, you want to make sure you check with the store as soon as possible. Same make, same model, same features, same identical item, and then whatever that fair market value is, or what would be the selling price, that is what you could report on your tax return. It's up to you. And we do, oddly enough, when I first started VITA, I didn't see a lot of prizes and awards, and now I see it all the time in the VITA program. Okay, and then jury pay. If you remember, when you went to jury duty, typically what happened is you received two payments. If you completed jury duty, you got payment for what is called jury pay, and it depends on the jurisdiction. It's not a whole lot of money. I think the last time I looked, I think it's like 15 or 20 bucks a day, something like that. And then typically some courthouses will give you what is called reimbursement for your one-way mileage. So reimbursement, that's one of those exclusions that we talked about. That's not reported as a taxable event. But the jury duty pay that you received is reported on your return. And so what you want to remember, step one, report your jury duty pay on your tax return. And then step number two, if you turn over your jury pay check to your employer, and sometimes that's the case because your employer compensates you while you're on jury duty pay, then step number two, you report that as an adjustment to income. And what that means is you net out or you zero out that jury duty pay. But mechanically, step one, report it, and then step two, report the adjustment to income. I'm going to hesitate for a moment, Sean, see if you have any questions from the participants.
Actually, I had one question for, if somebody sets up a GoFundMe account and a lot of people donate money to them, how is that treated? Is it taxable or non-taxable?
Yeah, what you want to go back to the qualified charitable organization. So if you're donating money to a GoFundMe, let's say someone had a fire in their home, then you're a nice person and you're giving money to people who either want it or need it. And so there's no tax consequence to you. No. You're not donating to a qualified.
No, Jerry, you're misunderstanding me. I'm saying our taxpayer is the one whose house caught on fire, and they received all this money. How is that treated?
Case, yeah, when a taxpayer receives gifts from people, as the recipient, you're not going to report that on your tax return, whether you receive $500 or $500 million as a recipient, if it's a bona fide gift. And I've seen that before. Typically, it's funeral expenses. Someone's passed away, and there's no tax consequence to the donor or the donee. All right, anything else, Sean?
No, I don't see any more.
All right, let's go to our next one. Now, this is a busy slide, so we'll take a little bit of time talking about this. And I think I mentioned last week, in the VITA program, you're probably looking at maybe 10% of your clients or your taxpayers are going to be Schedule A folks. Of course, it depends also on the VITA site. You might have an older or a senior crowd, and a lot of them have medical and dental expenses. And I think I use an example. I've got a client, she's 90, one of my paying clients, and she has a Schedule A because she has lots of medical expenses for both her and her husband. So you may see that, but it's still good to know, because if someone is able to itemize their deductions and take that benefit, then of course you want to make sure you do the right thing. And since we don't do married filing separate returns in the California VITA program, what that means is the taxpayer is either going to take the itemized deduction that you calculate or the standard deduction, whichever is greater. Okay, so let's talk about medical and dental expenses. And if you have your electronic version, you can refer to page F-5. But this is what you're able to deduct on a Schedule A. Your medical miles, and that would be the miles that you drive to the hospital for yourself, or maybe you have a spouse, or maybe you have a dependent that appears on your tax return, and your medical miles are 16 cents. So when you visit the doctor, you visit the nurse practitioner, the dentist, those are medical miles to and from your house. And then your out-of-pocket medical, and this is probably the best way to describe it. I use the term out-of-pocket. So what that means is a lot of people have insurance. They have medical and or dental insurance. And that medical and dental insurance, it may reimburse them for some or all of your expenses. But the unreimbursed expenses would be considered out-of-pocket. So for example, when I visit my dentist, we have dental insurance, and I think we pay approximately, maybe $300 a year for dental insurance. And so that is an insurance premium, which is a deductible expense. And then when the dentist gets done, I check out at the front desk, and the checkout person says, "Jerry, you owe us $80 for the dental treatment today." So I write a check or give them a credit card or a debit card, and that's an additional out-of-pocket expense. And you're going to have a lot of out-of-pocket expenses when you're talking about medical and dental. When you visit the emergency room, a lot of plans require you to pay $100 or $150 for you or your kids. And so again, that would be out of pocket. And then when you think about other types of expenses, it's pretty varied when you go into the publication. A lot of times you're going to see perhaps maybe hearing aids, eyeglasses, those are examples. Nursing services for some of our clients, you might see that, because a nurse is a medical professional, and that's part of your medical expenses. And then I haven't seen this in the VITA program, I think maybe one time. You might have someone who uses a guide dog because they're visually impaired. And if that's the case, and of course you have to feed a dog, you got to take a dog to a veterinarian, all of those are considered medical expenses for that person who needs that guide dog. And the rule that I learned many years ago when you're talking about medical and dental expenses, it's going to bring the person back up to where they were. And so, for example, if you slip and fall and break your arm, and then you have to pay $500 out of pocket, then that's a medical expense. If you decide that your biceps are too small, let's say you're a guy and you want bigger biceps, and you go into a plastic surgeon and you get what are called bicep implants, that's not going to bring you up to your regular condition. So that's generally not going to be a deductible expense, and you rarely see that in VITA. We're talking about implants, but again, if the implant is medically necessary, someone has had cancer, someone has been in some type of accident, and they have some type of implant to restore them to their original condition, if you will, then that would be considered a deductible expense. And then things that are not deductible, a lot of people do this. You go to the dentist and you get you don't like your teeth and you want them whitened, or you buy a kit. That's non-deductible. If you're an expectant mother, you have maternity clothing, that's not deductible. And cosmetic surgery, and when you look at cosmetic surgery, does it bring that person back up? So for example, if you had someone who had some type of cancer and they've got surgery to restore them again to their original condition, that would be a deductible expense. But if you have someone who's having cosmetic surgery because they have perhaps maybe a chin that has some sagging skin and they want it nice and tight, they want to look like they're 50 again, that would be cosmetic, and that's not deductible. And of course, as I mentioned before, there's the general rule, there's exceptions to the general rule. And what that means is if you have an exception, you're probably going to go to your site coordinator and say, hey, is there something out there in the tax world that could be an exception to cosmetic surgery? And the answer is there's a truckload of them, of exceptions, but that's something you want to bounce up to your site coordinator. But generally, cosmetic surgery is not deductible. Okay, I'll hesitate for a moment and see if, Sean, if you have any questions from anybody.
No, Jerry, I just saw a comment that the California itemized deductions are different, but I mentioned that we're not covering California yet. We're just going through federal.
Yeah, that's an important point. When you're talking about California, I always tell people, think of the federal government, it's a cat, and the state government's a dog, two different species. And you have two different, you have the Internal Revenue Code that covers the feds, and you have the Revenue and Taxation Code that covers the state of California. Now, what happens is California does conform to a number of things when we're talking about federal law, and that's imported automatically when you calculate that in your software. But there are certain things that California allows that the federal government doesn't. And I think one of the examples I can think of off the top of my head, and we're going to go through this in a scenario, but not today, is when you pay someone to prepare your tax return. Well, you cannot deduct that on your Schedule A on your federal return. On the California return, you can take that as part of California itemized deductions. And so we'll talk about that. But again, there are differences. Okay, let's see. Anything else, Sean, or should I march forward?
There's another question. Can we deduct attorney fees?
Well, when you say attorney fees, that probably means generally no. But what type of attorney fees are you talking about? If the individual paid attorney fees because they have a Schedule C and they need the attorney to intervene in some matter pertaining to the Schedule C business, then that may very well be a deductible expense. And that's the whole thing. And I don't profess to be a genius when it comes to taxes. I tell people I know a little bit about taxes. And what you got to do, I think you have to ask those detailed questions. You have to be compassionate. You have to be respectful to the client. But you've got to elicit the information. And sometimes clients are going to be forthright. They're going to tell you everything very quickly, very succinctly. Other clients, they're going to talk for 10 minutes and you're going to scratch your head and say, I don't think I got the answer. So that means you got to ask those follow-up questions. And then quite frankly, you might have to bring somebody else and say, hey, I don't quite understand this. So ask follow-up questions, rely on your publications, and don't be afraid to tell people I got to look it up. And this is important. I'll mention this. In my practice, I do 1040s. I do corporate returns. I do partnership returns. I've done 990s. Those are nonprofits. And I get clients all the time that ask me, Jerry, is this taxable? Is this non-taxable? Is it deductible or not? And sometimes I look at the fact pattern and say, I have no idea. I'll look it up though. And you may see that in the VITA program. I've seen that in the VITA program. And so that means determine, first of all, if it's in scope. And if it's in scope, then we can find the answer because you've got a really good team. I see some names on the screen here, some very, very accomplished preparers. So you're in good shape at St. Killian's. Okay, so let's move on to state and local taxes.
Jerry, there was another question really quick that came in. If a life alert is deductible, can someone deduct their Apple Watch if it has life alert?
Ooh, that's a good one. That's probably one of those things I would probably say if you've got an Apple Watch and has, and I don't have an Apple Watch and it has a life alert application, then perhaps maybe you're going to be able to deduct that application. As far as the Apple Watch, that kind of tells me it's kind of like a watch, which means it has certain abilities. And the last time I heard of a watch, that's a personal item, that's a personal expense. So you might want to ask the follow-up, is there an application fee or is there a fee to download the application for the life alert? I don't know if you have that just-in-time thing. Yeah. So again, I think that's what you want to do. And yeah, I would do that, because when you're talking about, and this is another thing, you're going to see this in the VITA program. You're going to see this if you're a paid practitioner. You always have people who are purchasing things for their personal life. It doesn't matter who they are. They could be living in their car as a homeless person, or they could be the president of the United States. Everybody has a personal life. Everybody buys stuff. They buy TVs, they buy computers, they buy watches, they buy shoes, purses. And so what you have is sometimes they want to interject that into the tax world and say, I purchased these items. Well, if you purchase an item, I would always say, what does that have to do with your business? Or is this something that is deductible? And if it is, we'll find it in the publication 4012. But generally what is called personal and family living expenses are not deductible. And you're going to see that a lot in VITA, especially with Schedule C clients. They're going to say, I bought this. And you're going to say, okay, is it ordinary and necessary to your business? Is it reasonable in amount? And does it have a business purpose? I mean, I'm in business. I'm a Schedule C guy. I buy a bunch of stuff, and a lot of stuff I buy has nothing to do with my Schedule C tax business. It's personal. I buy coffee. I buy a coffee cup. I buy shoes. Not deductible. I even buy computers, and some of my computers are not deductible because I don't have 6 computers that I use in my business. Okay, moving on. State and local taxes. This is something you're going to see if individuals itemize. And what that means is when they have withholding from their paycheck. And typically when you're a wage earner, you're going to have withholding. And then that withholding, the employer, of course, withholds it. And then they remit that to the state of California. And so that's going to appear when you enter that in the W-2 in the software. It will auto-populate on the Schedule A as an alpha. And then sometimes, I think the first time I saw this is St. Killian's. I now see people making estimated tax payments to both the federal government and the state of California. And that's good because they may have insufficient withholding, or maybe they're self-employed. And that means they want to make those payments so they can hit that 90% mark during the year, which means 90% of your liability you want to pay during the year. And so those state tax payments, you want to ask about that, and then you want to enter that into the software if they've made state tax payments. And then there's also, if you don't want to do what is called the state withholding, state tax paid, and state estimated tax payments, you have what is called local sales tax. And local sales tax, it's an option, either or, the state tax you pay or state and local sales tax. And in the publication, it talks about that. I don't see that very often. And what that means is that when people want to take that deduction, they're going to come in with a stack of receipts. And so I would encourage you to, when you go through your refresher training in January, I think you have it, you want to take a look at state and local taxes paid. And then when you hear the acronym SALT, S-A-L-T, that's state and local tax. And for our purposes in tax year 2021, the limitation is $10,000. You may have someone that says, hey, wait a second, I paid $16,000. And you acknowledge the individual and say, yeah, that's true. But there's a limit. The limit that Congress put in place is $10,000. And so that's it, $10,000. Okay, next, real property tax. This would be on your personal residence. And then, of course, some people will have their property tax bill. They write a check or they make a payment with the debit or credit card. So that real property tax, they pay on their residence. And typically in Orange County, they're going to make 2 payments. So you're going to see that. You're going to see that property tax bill. And then personal property tax, typically what I've seen, it's going to be on an automobile. And you look at that DMV bill, and there'll be an amount that says this may be tax deductible. And so you might have a couple $100 there. And if someone has 2 or 3 cars, and keep in mind they're paying personal property tax on each and every one of those automobiles. So that's something that also goes into the Schedule A as an alpha. Okay, I think this is probably a good point to take a break. Sean, do we want to entertain any other questions or go right to a break?
If anyone has questions, type them in the chat now. I'm not seeing any.
Okay. All right. So why don't we come back at 10:01, give you 10 minutes, and then we'll jump into the rest of our presentation.
All right.
Hey, Sean, Jerry had a question for you.
Yes, Jerry.
When we get to the tax return for David and Ali Quinn, can we do it this way? Can you bring up the software in Practice Lab, and then I'll kind of walk you through it. You can make the entries.
Yeah, sure.
Okay. All right. Okay, good deal.
Will that be the second hour or third hour?
That'll be the third hour. We should start the return at or about 11 o'clock.
Okay.
Okay, Sean, let me know if we're ready to go.
I think we're ready to go. We got about 30 seconds, but you did get one question during the break. I don't know if you could see it in the chat there.
And what's the question?
Is the monthly life alert charge a deductible medical expense?
You know, I have not heard that one before. I would probably lean toward, yeah, it is, because the way I understand it, you would pay a fee, and in case you have some type of medical emergency, then it's going to alert a service where they're going to dispatch some type of aid to you. So I'd probably lean toward, yeah, it is, but might have to look that one up. Again, I know what it is. I've seen the commercials, but I haven't had that question as far as a tax question.
And I think it's a good time to point out that all medical and dental expenses fall under the caveat that it's not deductible unless it's more than 10% of your.
Say that again, Sean, a little louder.
There's a limit on medical and dental expenses where you don't get to deduct them until they're 10% of your income, right?
Oh, that's right, because when you enter the medical expenses and dental expenses, then what happens is the software is going to limit that to, you have to exceed 7.5% of your AGI. Okay, I think we're ready to go, so we'll jump into the home mortgage interest. For those of you who itemize or your clients itemize, most of the time they itemize because they do have a home and they are paying interest on that loan. And the home mortgage interest is usually, this is something that usually is not a difficult or a complex deduction, but sometimes you're going to have those questions regarding a loan balance that might be more than $750,000. And so there's a limit to that. It's based on that Tax Cuts and Jobs Act of 2017. So if you do have a question where you've got a very large mortgage and you say, okay, what do I need to enter into the software because there's a limit, then you get into that publication 936, or just go to your publication 4012. But do keep in mind that there is a limit to interest on those mortgage, and that would be for a married filing joint $750,000 loan. And the interest on that loan is going to be most likely deductible. Anything over that, as far as interest, would not be deductible. And so typically your home mortgage interest is going to start with an information return called a 1098. And if you own a home, you probably get one of these if you still have a loan on the home. The 1098 shows a number of things. It really depends on perhaps maybe the age of the individual. It might pertain to if they have some type of impound account. When you hear the term impound, generally when you buy a new home, you might have an impound account where the lender wants to make sure that you are paying your property tax and you are paying your insurance. And so then what happens is the lender then would get more money from you, if you will, month by month, and then make those payments on your behalf, which is, of course, still deductible as far as the property tax. Your homeowner's insurance is not deductible on your primary or private residence. And so again, a lot of people will take that interest deduction. That would be interest received by the bank or the mortgage company, and that would be stated on the 1098. Other things that may be stated on the 1098 might be mortgage insurance premiums, which are deductible. We'll talk about points in a moment. And then you might have someone who has a reverse mortgage. And the publication 4012 does a really good job talking about reverse mortgage. So what you have is you might have, if I remember correctly, I know you have to be in your 60s. I want to say you got to be at least 62 to get a reverse mortgage. And so what that means is you have someone who makes a choice. I believe they have to be mentally competent because they're going to sign a contract. But what they do is they go to the bank, they got lots of equity in their house, and they say, hey, I want to get a reverse mortgage. And they have to qualify. And then what happens is they receive typically a monthly payment from the bank, and that's considered a loan. And so what that means is when you borrow money, there are no tax consequences. And so you're not going to pay income tax on a reverse mortgage that you're receiving monies each month. And then, of course, when you have a loan, just about every loan I can think of has interest associated with it because the people who are making the loan are trying to make a profit. And so interest, it's not paid, but it's accrued. And what that means is that interest that's accrued, it's considered a home equity debt and it's not deductible. And so you might have a taxpayer who has a reverse mortgage, and that would be perhaps maybe good for them because they're getting a monthly payment. They're able to pay their bills and still stay in their home. But again, keep in mind for tax purposes, it's not going to go on the Schedule A as an alpha. Let's talk about points. When you have someone who purchases a home, a primary residence, what happens is a lot of times, of course, in the contract, they will pay a fee or points for the loan to obtain the loan. And I've seen points as low as 1%. I've seen points as high as 10%. And so it just depends on the financial institution, and there might be some statutory requirements out there. But the bottom line is you're going to see those points reported on the 1098. And when someone has paid points to buy a home, they can do it two ways. The general rule is they're going to amortize those points. And so what that means is, in the example on the screen, let's say they paid $3,000 in points to obtain the loan. And let's say the loan is 30 years, and you do the math, and that's $100 per year. That doesn't sound like a whole lot, so that doesn't excite people. So maybe they don't want to amortize. If they don't want to amortize, they can take what is called the exception to the general rule, and they can go ahead and deduct their points in full. And so that's something you're going to have that discussion with individuals, whether they want to amortize or whether they want to deduct. And if I remember correctly, and I never took Latin in school, but I think the term amort or amortize relates to either dying off or killing off. And so that's what you're doing with a loan. You're paying it off. You're extinguishing the principal. So again, I've seen that in VITA many times, and I usually tell people this is the general rule. These are your exceptions. And I think 100% of the time people say, I want to deduct it in the year that I pay it. And I say, okay, we can do that. And then also in your textbook or your publication 4012, it talks about refinancing, and you have to amortize the points when you refinance unless you're going to use it for remodeling, and then you can deduct it in full. But again, Pub 4012 does a really good job talking about that. And then keep in mind, you're going to run into oddball situations from time to time. Don't be shy asking one of your senior folks or going to that publication 936 and looking up interest information. And again, when you bump into a scenario, make sure it's within scope. And typically, if you're not sure, then you can go to a senior person, your site coordinator, say, is this within scope of the VITA program? And sometimes you're going to get a situation, it's out of scope, and you're going to tell the person it's out of scope, and they're going to say, well, what do I do? And I usually tell them, well, there are practitioners out there that can help you out. I'm not going to recommend one, but you can go on various websites, but we can't help you out here. And I think the mantra is, if you tell people in a fair and a firm and respectful manner that we cannot help you because your return is out of scope, then what happens is they understand that. They may not be happy, but they'll go out and seek a paid practitioner. And then private mortgage insurance, that's reflected in your Pub 4012, and that's something else that can appear on the Schedule A. Again, most of those items are going to be reported on the 1098. And again, typically in the VITA program, they'll have a 1098 from their mortgage company. Okay, any questions or comments?
Jerry, there was one question. Someone asked if the rules are the same if they live in a co-op.
Yeah, when you use the word co-op, what that means to me, that means someone has title in a unit, and that all of those units are in a building, and then what they do is kind of like a condominium, and then they pay what are called monthly maintenance fees along with property tax. And so if that's the case, if you have a co-op, then think of it as like a condominium. You're going to be able to deduct the interest that you pay because you're on title and you're paying that loan. You're going to be able to deduct property tax, but that maintenance fee that you pay, that monthly maintenance fee, is not a deductible item. All right, let's go to the next slide. This is something I see a lot of. I see it in my practice. I see it at the VITA site, charitable deductions. And when you're thinking about charitable deductions, you're thinking about mostly cash that's paid by a taxpayer, sometimes tangible personal property. That could be a can of corn. It could be, I think the last time I gave something away, I think it was either a refrigerator or a couch. But when you're making charitable contributions, it has to be to a qualified charitable organization, which means they're going to share their tax-exempt ID number with you. And as I mentioned before, I've seen one egregious case where a woman was donated, and this is like 3 or 4 years ago. She was donating $8,000 a year. That was a lot of money for her, and the monies were going to an organization that was not qualified. Qualified means they approach the IRS and they say, IRS, we do charitable things, we do scientific things, we do things that help out people, and within the Internal Revenue Code, and we want to be considered tax exempt. So they make an application, IRS looks at it, IRS approves it, and at that point, contributions that they received are not going to be considered taxable. And so that's really important, especially if you don't have a tax exempt ID number, or you have a scribble on a piece of paper that says, we donated money to the Boys and Girls Club of Catalina. Well, the Boys and Girls Club of Catalina may or may not be a tax exempt organization. And the way you can do it, and Sean, are you able to click on that URL where it says irs.gov?
Yeah, I can click on that, but I'm going to have to stop sharing the screen because it'll bring up a different screen.
Okay. Yeah, let's do that. Let's see if we can. If it's a bridge too far, then we'll march on. But let's see if we can show that to the crowd.
All right.
And then as Sean is loading this up again, that's really important because the last thing you want to do is have the person take a deduction for monies that they've contributed to an organization that's not qualified. And there are many, many different types of qualified organizations. A lot of people say, well, what about churches? Well, there are many different types of churches. And there are certain churches where they don't want to deal with the United States government. Their ministers do not go to some type of seminary. These are people that just decide that they want to proselytize to their flock in their home or in a building, and they can call themselves a religion, but they're not a tax exempt organization.
Okay, Jerry,
so,
are you seeing the tool there?
Yeah.
Okay.
So I can see the screen. So if you can see the screen, this is the IRS website, and it talks about the organizational search tool, and this is where you can drill down. There used to be called a Publication 78, and it was a big blue book that had all the organizations. But again, you want to just make sure there's a tax exempt ID number. And if you're familiar with the organization, very, very well. But if not, you can do the download, or you can do you can drill down to the organization. And if you're concerned about St. Killian's, do not be. St. Killian's is a tax exempt organization. So if you donate money to St. Killian's, good for you, good for St. Killian's, and that's tax exempt. I think that'll do it. Thank you, Sean.
All right.
So we'll go back to our slide deck. And then if you donate money to an individual, keep in mind that individual may have a family member that's sick. That's not going to be tax deductible because an individual is not a qualified charitable organization. And so I remember one time I gave money to a guy. I don't know if he was legit or not, but it was a pretty sad situation. So I gave him some cash, some currency. And my son asked me, well, why did you do that, Dad? I said, well, he looked like he needed some money. And then my kid asked me, is that going to be deducted on your taxes? And I said, no, because I gave it to an individual. Okay, and so that's that. Now, you remember from last week in tax year 2021, if you're making contributions, cash contributions, and you do not itemize, you're going to get that $600 deduction, up to $600 on page 1 of your Form 1040. And so again, you do want to ask people about cash contributions. And when you make non-cash contributions typically might be maybe cans of food that you give to the St. Killian's, I believe it's called a food bank. And of course, then you can take a deduction for that. And then if you're driving miles for a charitable organization, you can also take a deduction for that. And then keep in mind, if you're driving for a charitable organization, you get 14 cents a mile. You want your client to have some type of accounting system to account for those miles. You might have to have them reconstruct. And then if they're engaged in charitable work and they have to pay for parking and tolls, that's something is above and beyond that 14 cents a mile. Well, miscellaneous, I don't want to spend a lot of time on this. That really the only one that I actually see anymore. Well, I see two of them. I see gambling losses. And just keep in mind, if you have gambling losses, you can only take them up to gambling winnings. And then you might have someone who is physically or mentally impaired. A lot of times you see what is called impairment-related work expenses. Typically, that's going to be for someone who has some type of visual impairment or physical impairment, and they're spending money out of pocket so they can go ahead and work, and that's something you can take as a miscellaneous deduction. If you're new or nearly new to VITA, you might remember the olden days where you could take 2% of your miscellaneous deductions. There's a laundry list of them. Those 2% miscellaneous deductions went away a few years ago under the tax legislation. Sean, did you have a question?
Jerry, there's a question in the chat about, is there a maximum amount for charitable deductions?
You know, as it says on the screen, up to 100% of AGI, that's a maximum amount for cash. I don't think you're going to see that because obviously people have to live. You might have an oddball situation where someone has a lot of money in the bank, they have a modest amount of income, i.e. that AGI, and they want to donate all of their income to a charitable organization. But I think typically what you're going to see, you're probably going to see maybe 10, maybe 20%. But again, up to 100% of your adjusted gross income for cash gifts. Let's go to the next slide. So we're going to go through an example at 11 o'clock, but we want to give you kind of a quick intro to the Schedule C. The Schedule C is it can be very basic and is very basic for VITA. So if you know anything about accounting, think of an income statement. So the Schedule C, you're going to report your income that you received, and you're generally going to deduct expenses that you've paid. And so think about gross receipts. That means all of the income that you received, and that would be Federal Reserve notes. We call that currency. It could be a check, any type of negotiable instrument. It could be a Zelle payment. Like, for example, some guy called me a couple of years ago, says, Jerry, I'm ready to pay my bill. This is a paying client. I said, great. He goes, I'm going to pay via Zelle. And I'm thinking, what's Zelle? So he explained it to me. I said, oh, okay, that's easy. So I went to my bank account. I set it up. He made a payment, and that's part of gross receipts. And of course, we only do the cash method in VITA. We do not do the accrual method. And so you're talking about monies typically that are received by the taxpayer. And then, of course, we don't do what is called cost of goods sold and inventory. Stay away from that. If they have that, just tell them, sorry, we don't do this in VITA, out of scope. And then sometimes you'll have other income. You just ask them, tell me about all your income for your business, and typically it's going to be included in gross receipts. You're going to see in the software the term material participation. You can actually go to that regulation that's stated, and you can read, and it's quite detailed. But what I tell people, we only do material participation in the VITA program, which means they ran the business, they did the work, they're involved on basically a day-to-day basis. And so for VITA, you're going to click that. If you're a paid practitioner, that's a different world. You're going to ask additional questions. Qualified joint venture, it simply means if you have a married couple, they're involved in a Schedule C, and it's a 50-50 deal, then what they can do is they can go ahead and indicate that in the software. And then what will happen is the software will create two Schedule C, one for the husband, one for the wife, split the income, split the expenses, and then you're going to have net income of both Schedule Cs. Now, what's important there is you might have a couple that's involved 50-50, and they want to take advantage of Social Security eventually. And so that means they have net income, they pay self-employment tax, which may give them a qualifying quarter. And then deductions, I've had many questions over the years, and I'm sure our experienced volunteers have had many questions. It really boils down to this. It has to be ordinary and necessary for the business. There's got to be a purpose, and it has to be reasonable in amount. And I think the example I gave you, I have a tax business, and let's say I ask my son to prepare a flyer. He's really good with computers and preparing a flyer. So he spends an hour doing the flyer. He comes down and says, "Dad, here's the flyer." "Okay, thanks." And then I give him $7,000. That's clearly not a reasonable amount. The reasonable amount may be 100, maybe 150, but it's not $7,000. And so that's something you want to keep in mind. And then for phones, we've had a number of discussions about phones. The bottom line is a landline, which means something in your house. It's not a cell phone. It's maybe mounted to a wall. That's not a deductible expense, even though it may be used for business. You cannot deduct landline, that first landline. You can't do it. Your cell phone, you can deduct your cell phone, but here's the rule. You have to basically itemize out your business calls. And so, for example, I've got one cell phone. I use it for everything. And I don't have the time or the interest to itemize out my actual business calls. I don't even know if I can do it. And so I do not deduct my cell phone from my Schedule C business. You may have someone who wants to do that, but again, they got to itemize out. There's a couple of tax court decisions on that. And then internet, everything I know about internet, if you got internet service at your house and you got one carrier, I think that's kind of like a landline. You're not able to deduct it. I've got internet at my house. I got one carrier. I use it for my business. I use it for personal, talking to friends, all sorts of stuff. I don't deduct it on my return. And then also on Schedule C, no employees, no depreciation. We don't do that. And if someone says, "Well, I have one employee or I want to depreciate something," you got to tell them, no, it's out of scope. And you just got to move on. But again, do it in a fair and do it in a respectful manner. And I think your client's going to understand that. All right, next slide.
Had a question really quick, Jerry. If the business accepts Bitcoin or any kind of crypto payment, does that put them out of scope for VITA?
Let's see. If you receive Bitcoin, oh, that's a good question. I'm gonna be really candid here. I don't know. I can't remember. So I'll tell you what. Let me jot that down, and I'll do some research, and I'll see if I can give you an answer.
All right.
Next week, that is. We're talking Bitcoin received as part of gross receipts.
Yes.
Okay. Let me look that up next week or in the week and see if I can get an answer. Okay, let's run through the rest of these. And again, we have an example for a Schedule C, a very basic one. But when you're talking about vehicle expense in the VITA program, we only do the what is called the standard mileage method. And this is important. If you're a taxpayer, you have to have a method to account for not only income, but also to account for your expenses, including your vehicle expense. And there are different ways to do it. If you've got a cell phone, you can probably type in information regarding the miles that you drove. If you've got a day timer where you write down in pencil or pen, but you have to have a method. And if you don't have a method, then you got to reconstruct. Reconstruction it's permissible, but what that means is the taxpayer is going to reconstruct. And I've actually had taxpayers at my site. They say, "Jerry, I drove my vehicle." I said, "Okay, well, go sit in the corner and reconstruct your miles while we help someone else out. And then what we'll do when we talk to you, we'll include that." But again, you're talking about the standard mileage rate. And in 2021, for tax year 2021, it goes down to 56 cents a mile. And then there's other things you can deduct, the business portion of the interest if you've got a loan on your automobile, your DMV business portion, which means you're going through an allocation. If you pay parking fees and tolls, that's above and beyond that 56 cents a mile. You can also take that. And again, this really boils down to not only the expenditure of monies, but also the accounting for these various expenses. And then keep in mind your estimated tax payments. A lot of your VITA clients, they're going to be really surprised because at the end of the year, if they're self-employed, they owe a lot of money. And they're going to say, "Well, yeah, because you didn't make your estimated tax payments." So encourage them, educate them. And it's very painful. I've seen this many times where people owe a lot of money at the end of the year. And I basically kind of counsel them, pat them on the shoulder, if you will, and say, "Hey, you got to make estimated tax payments. And it's not that hard. They're called quarterly payments. So you just got to make them, which means you've got to estimate your income. And if someone says, well, I don't know what my income is going to be like, well, then you can sit down and say, you probably can estimate it. And that's why they call it estimated. Look back and what do you think you're going to be making and make those payments. And then this is something we don't spend a lot of time on. It's basically automatic. This is that qualified business income deduction. It's 20%. And you're going to see that generated for your Schedule C clients that have net income. All right, let's go to our next slide. Schedule D, this is something you're not going to spend a lot of time on unless you get a taxpayer with a whole bunch of brokerage account transactions. And I'm not sure how the site coordinator is going to handle it. I know how I handle it at my site. If someone comes in with a stack of paperwork, usually we aggregate. But again, there's various ways to do it. But keep in mind, when you have someone who sells some type of stock or bonds, or their personal residence, or their personal vehicle, or even cryptocurrency, if they sell it, because cryptocurrency is considered a capital asset, then what happens is you're going to have to go through a calculation. Now, for cryptocurrency, we don't handle that in the VITA program. They have to go and find a paid practitioner. But a cryptocurrency, and there's a bunch of them out there, they're capital assets. So again, when you sell something, you're going to go through a calculation. Do I have a gain? Do I have a loss? We don't deal with any type of assets used in a trade or business. Someone has a machine and they sell it. If you got a machine and you use it in your business, you're required to depreciate it, which means cost recovery. And so we don't deal with that in VITA. So you're just respectful and you're firm, you're polite, say we can't help you out there. And then other things like inventory and accounts receivable, not considered a capital asset. Now, the good thing is about the software, you're simply going to indicate, here's the asset that I sold. You're going to indicate the amount you bought it for, the amount you sold it for, and then when you bought it and when you sold it, and the software will determine either short or long-term gain. And I think I've shared this story once before. One time at the VITA site, individual was a long-term investor and had $30,000 or $20,000 of long-term gains. And I had a CPA looking at this thing, and he was shaking his head. He goes, "There's no tax." And I'm looking at it, and I'm thinking, there is no tax. I'm thinking, oh, that's right, long-term gain. I forget what year it was. Up to a certain amount, there was zero taxable amount for long-term gain. So you're going to see that. Again, long-term gain, all you need to know, you can go through the worksheet if you want, but it's taxed at a preferential rate, which means a lower rate than short-term gain, generally. Okay, other things, this is something if you have someone who sells typically a house, you have what is called cost of the item, and then any additions would be cost plus, if you will, or what we call in the accounting world, the adjusted basis. And that's something you're going to bump into. I've seen that a number of times, typically for a residence. But before we get to the residence, let's talk about that 1099-B. Thankfully, most of your clients will have a 1099-B. And as I said before, I have seen 1099-Bs. I read them. I speak, read, and write fluent English. I've got an accounting background. I've got a tax background. And I've seen 1099-Bs I could not understand. So I would call the brokerage house and say, what is this document? What are you trying to tell the taxpayer? I don't understand it, and the taxpayer doesn't understand it. You may see that from time to time. So just take your time, ask some follow-up questions, but ask if the guy or the gal has a 1099-B. That's typically going to be most of your answers. And then your capital loss carry forward, what that means is if you have a capital loss, which means you sold the capital asset and there's a loss that's generated, you can only take $3,000 on your return, and then the rest will carry forward. And some people ask me, Jerry, when is this thing used up? So it's used up when you use it up or you're used up. But again, keep in mind, it's $3,000 maximum. And page Delta 23 in publication 4012 does a great job. Let's go to the next page.
Hey, Jerry, there's a bunch of questions that came in on both Schedule C and Schedule D, if you want to look at the chat.
Go ahead and pitch them.
Okay, so let's start out some Schedule C questions. The first one is, what about seasonal employees? I'm not sure what that means.
If you have an employee, what that means is you have to compensate them and you have to do what is called withholding. If you have a seasonal employee, the VITA program cannot assist you as a Schedule C sole proprietor.
All right, next question is for home-based business. Can you deduct your utilities as an expense?
You can deduct what's called a home mortgage office in the VITA program. We don't do home mortgage office. And if you look at the home office deduction, it does include utilities. And so the short answer on that is that we don't calculate that.
All right, the next question is, you said some car expenses are deductible. What kinds of car expenses are deductible?
Yeah, for automobile expense, you're basically going to bump into the mileage method. And so you want to make sure you look at their calendar and total up the total business miles that they drove. And then above and beyond that, you're going to have your tolls. You're going to have your business parking, anything related to business. And then can you go back to the previous page, Sean, for the Schedule C?
Yeah.
Yeah, so let's say, for example, you've got an automobile loan, and your automobile loan, you're paying interest on it. And so what you're going to do is you're driving that one vehicle that you have for personal use, perhaps maybe commuting, and then perhaps for business. And so you're going to go through an allocation. Let's say you drive your car, let's say 40% of the time for business and the rest for either commuting and or personal. And so you're going to allocate that 40% of the interest paid, and that would be that business portion. And same thing with the DMV, again, an allocation. And I would recommend this. I know, Mel, you're going to do what you're going to do, but usually when you take that senior preparer and you match them with the junior preparer, then they can explain to them allocation. Any other questions?
Yeah, then the rest of the questions are on Schedule D. So we have, how do you adjust cost basis on a 1099-B for non-covered shares if the mutual fund reports a cost basis different than what the taxpayer says?
I think the short answer there is when you receive an information return and the taxpayer insists that the information return is incorrect, then your first step should be, okay, taxpayer, go back to the entity that issued the 1099 and request an accurate 1099. I think that's probably the way to do it. And you're going to avoid a lot of issues. You want to get that corrected 1099-B.
Okay. Another question is, if a client has lots of stock sale transactions, can they be entered on a summary basis, short-term or long-term?
Yeah, this is what I do. And we'll have people with 20 or 30 different transactions. And so usually what we'll do is we'll aggregate the ordinary and we'll aggregate the long-term. And what that means is your preparer is saving a lot of time. And I think it really boils down to what the site coordinator, the guidance that the site coordinator is going to give. What I do at my site is, of course, yeah, it's case by case, but we will typically aggregate short-term. And what that means is all of your capital assets that were disposed, all the short-term ones are being treated just that, short-term, and all the ones that are long-term capital assets, they're treated long-term. So you're paying the right amount of tax and you're saving a lot of time. If you're involved in some type of tax practice, what you might end up doing, you might end up making those entries as opposed to aggregating. But again, it just depends.
That's it for questions.
Okay, let's go to our next schedule. This is something that you might want to keep in mind. A lot of people, they hear the term capital gains distribution. It simply means you've got typically a mutual fund or a regulated investment company, and they have shares in other corporations. And so they sell those shares, which means they're disposing of capital assets. And then for that mutual fund shareholder, you have what is called a flow or a flow through to the shareholder, and that's titled a capital gains distribution. That is a different animal than a capital gain. So you just want to keep that in mind. And that'll be typically reflected on that 1099 DIV. Sale of a residence, you see this in VITA. I think I've seen this maybe once or twice each season. If you're going to do that, highly recommend you get and it's not super difficult, but you want to get that senior preparer matched up with that junior preparer. And keep in mind, when you sell your home, you might be able to take a maximum exclusion of that capital gain because your house is a capital asset. You dispose of it, you might have a capital gain. and excluding up to $500,000 is a good thing, but you have to meet certain rules. You've got to own the home 2 out of the last 5 years, and then lived in the home 24 months of the previous 5 years. And if you meet those requirements, then you can exclude, which is a great thing. Your Pub 523 does an excellent job. And then I always tell people selling a home and calculating gain on a home, the big elephant in the room, if you will, is determining adjusted basis. And determining adjusted basis, think of someone who bought a home 30 or 40 years ago, and now they're selling it. They may have put in a swimming pool, which would be an improvement, i.e. part of the adjusted basis. They may have put in a second story. There's many different things. So you want to differentiate between repairs and improvement, and your publication 523 does a really good job. And here's another thing. You want to get your hands on, if available, the settlement statement when they bought the house, and the settlement statement when they sold the house, because there's certain things that go into what is called that adjusted basis, which includes your, as shown on the screen, your title fees, recording fees, things like that. And I don't think this is complicated. I don't think it's difficult, but what it is you have to go through a number of steps. And if you're talking to someone who's 75 years old, they have probably a lot of different improvements, and they're going to pretty much tell you what they are. And then here's another thing that comes up. Let's say you put in a swimming pool, and they don't have the contract, and they don't have the canceled check from 30 years ago. Well, there's other evidence that can substantiate the expenditure. Now, I think probably the best way to do it, explain to them that they need to be prepared if they are examined by the IRS. You're not the examiner. You're just going to recommend keep your records, and then just be prepared if you're asked questions to substantiate those improvements. And then that way you're going to have a client that's going to be happy. But this is something that you see a lot of. And in Southern California, I mean, this is different if you go to, and I'm not making fun of these states, I'm just saying you go to different places, like you go to little towns in Wyoming or little places in Louisiana or little towns in North Dakota. And when people sell their home, they may have a gain of maybe, 20,000. In Southern California, they can have a gain of 600,000 or 700,000. And so again, excluding up to 500K if you're a married filing joint, that's a really good thing for the taxpayer. Not good for the Treasury, but good for the taxpayer. So yeah, I think you want to spend time with the Pub 523, and I would not recommend a new or a junior volunteer tackle this. I would recommend they work with a senior volunteer so they can get some experience first. Any questions about this?
Oh, we just got one came in. What about stepping up the cost basis for joint tenancy? Will you discuss that?
I'm not going to discuss that right now because in order to do that, I think I want to bring in a few things which I haven't prepared for. So I've written that down, stepped up basis. And so what we can do, we can talk about that next week.
Okay.
All right, next slide. Just a few other things when you talk about the adjustments to income. These are things that you might see at the VITA site. Educator expense, that would be K through 12. That would be a school teacher buying items on behalf of their student, and that would be out-of-pocket expenditure. The penalty on early withdrawal, I don't see that much anymore, but basically what it is someone cashes out their certificate of deposit, and then they're paying some type of basically, let me restate that. They are receiving interest, and of course that penalty, it's the interest that they could have received. Other things that you might see, student loan interest deduction, there's a maximum on that. The IRA deduction is alive and well, the individual retirement arrangement, and you will see particularly low and moderate income taxpayers still taking advantage of that deduction if they can, which reduces their taxable income. And then what happens is when they take that IRA distribution many years in the future, then that would be a taxable event. And then we already talked about jury duty pay. Next slide. Okay, so what we're going to do, we're going to ask Sean to set up TaxSlayer. And Sean, if you would, if you just go nice and slow, because I know we got some new and nearly new folks. So let's start at the beginning, as they say, and let's just go to the IRS website and let's go through our practice lab.
All right, so I'll just go to the VITA site and I'll get everybody.
And then as he's getting this set up, again, we know if we're experienced volunteers, we know that the practice lab is a tax preparation software program called TaxSlayer. There are different types, but the IRS is contracted with TaxSlayer. Oh, this is good here. We'll stay here for a second. And so what happens is when you create an account, you're going to create two accounts, one for the certifications when you take the VITA test, and then one for the practice lab. And this particular website or landing page that Sean is on, this has an enormous amount of information. And what I tell people is your 4012 is your go-to book. The contents of these courses, you probably want to review them. If you read them word for word, you're going to be a very, very busy person. So you can review the contents of the course before you take the certification. And when you take those certification tests, I would recommend you do what I do. I utilize the publication 4012. I have it open in front of me. I also take what is called the IRS Form 6744. And then I will go ahead and, first of all, take the paper and pencil test. And then when I open up the software for the certification, I will enter my answers into the software and then hit submit. And then what I do on my Form 6744, I circle the answer, I calculate whatever the answer is, and then I reference the publication 4012, the page number. I actually write that down in my Form 6744. And that helps me. And then also when I teach, people ask me, and that helps me when I teach. But again, you're going to do what you're going to do. I do see people that go that certification route, and then what happens is they run through it. I'll embarrass an IRS agent, but I won't mention his name. He ran through the certification. Actually, I had another guy who was an enrolled agent, and they failed the certification, the basic exam. And then I looked at them. I didn't laugh at them, but I said, I know what you did. You think you know this stuff, and you ran through it real quick. You didn't bother looking up the answers, and that's why you failed. They go, yeah, that's right. I said, okay, now the next time, take your time, utilize the publication 4012, and realize there's certain things you're just simply going to have to calculate. And so anyway, that's my advice. But again, you're going to do what you're going to do when you take the certification. So now we're going to go to the software. And so Sean is going to hit the software practice lab. And the password is Train Pro Web, all one word, all uppercase. And then if you do not have an account, that's where you would hit create the account, you'd enter the data. But if you have one, then you enter your information. Okay, so real quick, before we go to the practice lab, we want to review one more time. Sean, can you cursor down and show us section 4? And so this may be of help to certain individuals. In section 4, preparing a return, there's these, I'll call them tutorials. And I think they do a pretty fair job. And so you can go through them if you want some refresher training. Some people, they don't want it. They want to go right to the software. But this is provided for us by the TaxSlayer folks and by obviously the IRS, again, to help us with these various topics. And then Sean, if you go to section 6, we're not going to open anything up. But if you are, like for example, I teach what is called a VITA 2 class. And my VITA 2 class, I stand corrected, my VITA 1 class. In my VITA 1 class, we go through tax preparation, and I will use some of these scenarios that are shown, practice return 1 through 7, with the exception of the married filing separate one. And so these practice returns, what they do is they will give you practice, and they will give you what is called a check figure, so you can say, okay, did I get it right? So that's, again, offered to you. If you choose to certify at higher levels, like, for example, if you work at my site, all of my volunteers are required to certify at the military level because we do help people out with the Schedule E as an echo for rental property. Okay, let's see. Sean, let's go to the top.
Jerry, there's a question in the chat, and this might be a good time for people to create those accounts so they can use TaxSlayer?
Oh, heck yeah. In fact, what we're going to do is we're going to take a break here real short so you can do that. Let's go to the top. We'll go for 5 more minutes and then we'll take that break and we'll give them a little extra time.
All right.
Okay, and Sean, go really, really slow. So practice area, that
All right.
big blue tab, and that's going to take you to the software. And then Sean, if you would humor me, go to the upper right-hand corner where it says change tax year. And so when you are practicing for the purposes of certification, because you're going to be volunteering in January, February, March, April at St. Killian's, you want to certify on the 2021 tax year. Now, as of Wednesday, I determined it was clunky, it wasn't working. So for instructional purposes today, we're going to utilize the 2020 software. All right, and so we're going to start a new return. And then Sean, in the practice lab, I recall you have to use 400, and in our scenario, David's SSN is 400008190. Okay, we'll start a return. And then we'll hesitate here for just a moment. Typically in the VITA program, your most challenging filing status is going to be the head of household. I would recommend you go to that decision tree in your publication 4012 and just utilize that, and you're not going to have any issues. But again, filing status usually is not a big deal, but head of household does pop up from time to time. And you should remember, for head of household, you have to meet certain rules, and you have to be either unmarried or considered unmarried for tax purposes. Okay, in this case, we got a married couple. And then we hit continue, we save the data. And then we're going to populate David, and his last name is Wynn. Middle initial is S as in Sierra. And last name common spelling Nguyen. He was born on May 1st, 1980. And his occupation is, he's a bank teller. And if you cursor down, you're going to see these various boxes right here. In the VITA program, you'll probably see the top one where someone can be claimed as a dependent. You might see a young adult who's over 18 and a full-time student. I think I told you I had a taxpayer last season. She was blind. We actually had a Zoom interview, and she had to tell me, she goes, Jerry, you probably don't know, but I am blind. I said, I did not know that. She goes, yes, I have zero sight. I said, I understand. I said, okay, then that's an additional deduction on that standard deduction. And then this is something we see a lot at the VITA site. You might have someone who's passed away, and maybe the mother, or perhaps maybe the sister has asked you to prepare a return for a decedent. And so this is something that, again, you see, and that's where you would check it. And then what happens is once the return is electronically filed to the IRS, there is, it's called the master, I think it's called the master death file. IRS maintains a copy of that. So if someone attempts to file a return, then IRS will say, sorry, you're not this person is deceased. And yes, my understanding is Social Security numbers are recycled, but I don't think they're recycled in the same year of death. Other things you're going to see, Sean, can you go down to the one right below it where it says $3?
Yeah.
You're going to see that a lot. And what that means is people can basically issue instructions to the federal government to have $3 to go into the campaign fund. Don't engage in a political discussion. Just say, do you want it or not? And if they don't, then don't check it. Let's see. Here's something we're going to see tax year 2021. Now we're looking at 2020 right now. So you can see this blurb where it says taxpayer wishes to elect to use their 2019 earned income to figure their 2020 earned income. So what you're going to see on the 2021 software for tax year 2021, you're going to see the same verbiage with the exception of the 2020. So it'll be replaced with 2021. So again, you look back period, you're going to look at 2019 if the taxpayer wants to do that. And so what that means, in my book, it means the taxpayer's got to have their 2019 return with them, and then you're going to determine what their earned income was. Let's see, I think that's pretty much all we need to talk about. Again, we don't deal with virtual currency. So if you have someone if they've purchased virtual currency, there's no issue there. We can help them with their tax return. If they've sold virtual currency, we cannot help them with their tax return. And if someone says, why not? Virtual currency is all over. You just tell them there are many things that are out of scope, and this happens to be one of them. And so we have to follow the rules. Okay, we're going to go down to the spouse information. We're going to populate that with the spouse. Your first name is Ali, A-L-I. Middle initial B as in Bravo. And her last name auto-populates, and her social is 400005012. And her occupation is she is a self-employed tutor. And then just a quick note here, when you're working with taxpayers, if you're new, her date of birth is June 6th, 1981. And when you're working with taxpayers, they're either going to be a wage earner, which means they're typically going to be issued a W-2, they're going to be self-employed, they may or may not have a 1099 that's issued to them, or they may be an investor, or you might have a taxpayer that's all three. And so, and that's usually the categories. And so when people ask me, what are the categories? I typically say self-employed, wage earner, investor. Okay, so let's cursor down. We're not going to make any entries here. And then we're going to put an address and any address in Orange County, California. And then you do have to capture a phone number for the taxpayer. And if the taxpayer is married, you might want to capture the spouse's phone number. That's always important. Okay, we're going to hit continue, and then once we get to the income page, or the California return, what we'll do here, we'll take a break now, and then when we come back, we're going to jump into this return, and again, we're looking at that tax scenario for the David and Ali win. So let's take 10 and come back at
Jared,
11:03.
before we take a break, there was a question that trickled in on the Schedule D while we were doing this. Do we do tax processing for sale of a private car, which was not for the business?
Did I hear a private automobile?
Yes.
Right. The private automobile is a capital asset. And so when you sell it, the term is dispose of it, you relinquish title, then you'll go through that calculation. Do you have a gain or loss? If you have a gain, then of course you have to determine, the computer will determine short or long term. If you have a loss on your personal automobile, it's not deductible.
Okay, thanks.
All right. Okay. We'll see you in about 10 minutes.
supplement the sale of a private car?
Whoever makes a gain on a private car.
Well, even if you don't, that's true, but even if you did, that income is taxable?
That's what he said. What he said.
It is possible now with the price of used cars. But the,
Pay more than it's worth. You're not gonna pay more than pay.
you would think,
Dick, you might want to mute your laptop.
Last year, they sometimes there's over 100 people. And they ever said, you really might. Sometimes.
ever have a hand sheet?
She has, this is what
And Sean, anytime you're ready.
Okay. I think it's a 2-minute warning here if we want to give them a 10-minute break because we went till 10:54. But I was wondering, Jerry, are you going to try to talk about the new customer portal feature in TaxSlayer?
Yeah, we'll talk about that probably our second to the last or last meeting.
Okay.
But yeah, there is the portal for those of you who are familiar with that. That's a feature where taxpayers can upload documents. Documents can be accessed, and then of course you can have a chat feature with your taxpayers. Yeah, we'll talk about that. There's actually a tutorial that TaxSlayer has put out there. I think it's about, I want to say about 5 or 10 minutes. I don't know if Mel's on the call. Is Mel, are you planning to use that customer portal from TaxSlayer?
Hey, did you guys just call Phil?
No, Mel.
Oh, Mel. Okay.
Anyways, Jerry, I've talked to Mel. I think we're only going to use it in a supplemental fashion for people who need to upload documents that they forgot to bring, because we think the size file limitations won't let us load everything we need.
Yeah, if I remember, I think the size limitation is 25 megabytes. So I went through that tutorial, and I'm not against the customer portal, but at Coastline, we are not going to use it. We're going to use our Lisio program that we used last year. Okay.
Jerry, how do you spell that program you're using?
Oh, Lisio, it's Liscio.
Oh, okay.
And
Thank you.
Lisio is a private company, so if somebody wants to use it, like we use it, we have to pay, I forget what we pay, I think it's $150 a month during the season.
All right, it's time to roll.
Okay, so we left off on this page, and so we're going to answer the questions here. So the first question is, did your name change? Typically, the answer will be no. And for renter's credit, we will talk about the California's renter's credit, not today though. And what that means is you're renting property in California for 6 months or longer. And of course, if you qualify, it is a non-refundable credit, which means it's a dollar for dollar reduction of the tax. We're going to put no. And then use tax, I know last year, St. Killian volunteers were asked to ask that question. And typically what that means, you're buying a big ticket item in another state, you bring it to California, you're using it in California, and the answer typically will be 0. But still ask that question, it is important.
I think I'm going to time out here. Hang on.
All right.
Oh, no. I may have already timed out.
Yeah, for the new and newer volunteers, what happens when you're using the software, you might get a message timing out. If that's the case, then you just go back in and do your client search and find that client that you entered the data for.
Bad news is it might not let you back on the screen again.
No problem. What's that one saying? This is not a bridge too far. We can make it happen. You might even, there you go, get out of it and log back in. Yeah, what's kind of nice about the St. Killian program, if you're going to do what you did last year, if you're not preparing tax returns in front of people, then when you do timeout or if there's issues, no problem. But when you're doing it face-to-face, it can get a little frustrating because the taxpayer is sitting there. But once you get that expertise, and typically you do about 10 returns, you get pretty comfortable. I don't think you're going to be an expert after 10 returns, but I think you're going to be comfortable. You'll be able to navigate through most issues. And then keep in mind, you got those senior preparers, rely on them, the ones who've done it for 5 or 10 seasons. All right, Sean, when you were ready, if you can bring up the software again.
Yeah, I'll be back in a second.
And while he's doing that, if anybody wants to come off mute and ask any questions or comments, we could do that.
So
Very good.
more on comment, Jerry. We will, our first year volunteer, we will walk you through. There will be an in-house coach on Saturdays that you can watch them prepare return real time.
Okay. Yeah, and I boast about St. Killian's all the time because I think it's a great program. You got a lot of great volunteers, and so if you're new or if you are newer, you're going to be in really good shape with St. Killian's. It's a great program, and Mel and his team, they've done a lot of work over the years. Okay,
Yeah.
so what Sean has done is he's come back to the software. You can see in the upper right-hand corner the name David Wynn. So we've got the taxpayer. And so now where do we leave off? We left off with, I think, the basic information. Did we answer all those questions?
Oh, yeah, we were in the California state page, which isn't coming back.
As I said before, that's the one page you can never get back to. It's a one shot only.
All right, well, we're not gonna sweat it. This is instructional only. So let's go to recovery rebate. And when you hear the term recovery rebate, what that means is if the individual is eligible, what that means is if they haven't received their stimulus payments, the federal one and two, then they may be eligible for this recovery rebate credit. For our purposes, we're talking about VITA clients. They're going to be under that income threshold. But the important thing, ask them about their federal stimulus payments, and use the word federal because people are going to get confused when you say stimulus payments. They're going to start thinking about California and or federal. So federal IRS payments. And in our scenario, they did not receive either one. And so Sean is going to mark that. And then if you know anything about the recovery rebate credit, if you know anything about preparing returns, last year, I had dozens and dozens of non-paying and paying clients that either did not receive their federal stimulus payments or did not receive the entire amount. So you just ask the question and determine how much they received or did not receive. We'll hit continue. And if you're looking at your scenario, there's a blurb about their daughter, the Wynn's daughter, Christy. She moved out, went to school, got a contract, got a job. What that means is she's out of the house, she's not being supported by the parents, and she cannot be claimed as a dependent. So we're going to go to the income item, and Sean's going to hit W-2. You're going to see a lot of this in VITA. And typically it'll be a standard W-2. We're going to select David on the left-hand side under employee. And we're going to go to the employer. And the mantra is you're going to key it as you see it. And so we've got a federal employer identification number of 952345678. And then when something auto-populates, if it's not per the W-2, no harm, no foul, make that go away. And let's plug in the name of the employer. The employer's name is Largest Bank. That'll work. And then your address, we're good to go. We got an address there. Okay, let's go to wages. And in this case, federal wages of $40,000. Federal tax withheld of $4,000. And then that auto population 3, 4, 5, and 6, if that matches your W-2, all is well. If not, Sean, for instructional purposes, go to Social Security tax, and instead of 2480, make that 2479. And then just key it as you see it. Okay, let's go down to box 12. Box 12 has a bunch of codes. In your Pub 4012, it describes all of these codes. You're typically going to use either D or DD. D means deferred compensation, typically a 401k, and then DD means medical insurance paid, premiums paid by the employer on behalf of the employee. In this case, his employer paid on behalf of him to the tune of $8,000. So DD, $8,000. And in your scenario, it covers the both the husband and the wife. We go to box 14. And in box 14, we have California SDI, and to the tune of $250. And then on box 13, he's covered by a retirement plan, and there are many different types. You have, again, 401k. You might have someone who has a retirement plan where they make only contributions of time. All right, we'll go down to state information. We're going to indicate California. And in the VITA program, we prepare California returns. Stay away from other states. Your site coordinator usually would tell you, you gotta stay away from other states. Okay, EIN. If it doesn't auto-populate, we're going to plug in an EIN. In this case, 7654321. That'll work too. But key it as you see it. And this is important. When you have an incorrect EIN, sometimes you're going to get a reject when that electronic return originator, the e-filing person, tries to e-file. For your state tax paid, that's really state income tax withheld and sent to the state. In this case, it's $1,500. And then we mentioned this last week, box 18, 19, and 20 for our purposes. You can leave that blank because there are no jurisdictions in the state of California that have individual income tax. So we leave that blank. If you're, let's say you move to New York State and you're in the VITA program, then of course the city of New York has a local income tax, and that's where that would go. Okay, we hit continue. And then we're going to go to, and if you had another W-2, which we don't, we go to the upper left-hand corner and we would add a W-2 wage statement. And can you kind of wiggle your cursor where it says add W-2? There you go. And we don't have one, so, and that's good. So what will happen, we open something up, we're not going to use it, we can hit cancel, and then we're good to go. All right, let's hit continue. Let's go to our next item, and this is going to be interest income. So we go to the 1099 INT. We open that up. And in this case, he had interest income that he received. And we click on interest income. Typically, you'll have a 1099 INT. Our payer's name is First Bank of the Third Best. And we've got an EIN of 33. Two, three, four, five, six, seven, eight. And then we're going to put in an address, 2115 Broadway. And the zip is 92691. Okay, in this case, we've got a total amount of $300. So in box 1, we'll indicate that $300 of interest income received.
Taxpayer or
300.
no, is it taxpayer, joint, or spouse?
Oh, in this particular case, it's David, so just taxpayer, and that's a good point. So you might have a joint account. That means husband and wife are on the account. We don't have anything for box 2, but if you go back to your scenario, it says you look at David's bank statement ending December 31st, 2020, and see that he has $45,000 in his account. And so that goes to net worth. He still can qualify as a VITA client because we qualify people based on income. So we're done with that one. So we can hit continue and at the bottom of the page. And if you had an additional item, whether it be interest or dividend, then you would go to that add interest and dividend and enter additional data. Okay, and continue. We're going to go to the jury duty thing. And if you read in your scenario on page 1, it says she was paid $80. So we're going to hit continue. And we're going to go to the bottom of this page where it says less common income. And we're going to hit that, and where it says other income not reported, we're going to click there. And we're going to indicate this is for Ali, taxpayer wife. Description of other income, this would be jury duty pay. And the amount of her jury duty pay is $80. And then I'll read in the scenario, it says she cashed the check that she received from jury duty, and then she donated $80 cash to a qualified charity. So what we're going to do, we're going to hit continue. And before we forget, we're going to address an $80 cash contribution to a qualified charity.
Does this count as earned income, Jerry?
We're going to leave that blank.
All right.
All right, so we're going to go over to the left-hand side of the page. We're going to go to deductions. And what we have to tackle now is that $80 she gave to a charitable contribution. So we go to itemized deductions. And we see where it says gifts to charity. And where it says cash gifts to charity, we're going to click on that top button. And then we're going to go to charity name. This is Let's Feed Everybody. And then the description would be cash. And then she made this donation on October 10th. And the amount that she donated is $80. Okay, so we're done with that particular entry. Let's hit continue. And then let's see. Sean, can you ask someone to come off mute? I want to ask him a softball question.
All right. How about Bow? He's not on mute.
Val? Are you with us, Val?
All right, let me try somebody else. How about Audie? Are you there, Audie?
Yeah, I'm here. What was the question?
Audie, a quick question for you. Do you have the scenario in front of you?
No, I don't. I do not recall that being emailed to me.
Okay. How about I read you something, and can you tell us if this is something that we need to concern ourselves with? So the statement is, I'm at the bottom of page 1 of the scenario. David and Ali spent $4,900 making repairs on their home. The repairs included work on the garage door, replacement of the kitchen flooring, and refurbishing their electrical breaker box. Do we need to concern ourselves with that?
This is repairs that they made on their home.
Correct.
It could possibly be a sales tax issue.
Well, you know, that could be, but for the purposes of income tax preparation and based on the data that we have here, there's no consideration.
Okay.
All right, thanks. Okay, so let's go to the next page. I'm on page 2 of the scenario, and basically says, hey, they want to take the greater of, whether it's the standard or the itemized. And so we're going to determine that if they get either the standard or the itemized.
And Jerry, just real quick, Jerry, I posted the scenario in the chat because some people said they didn't see the email.
Okay, good deal. All right, I'm on page 2 now. The next item, it says Ali received a cash inheritance from the estate of her great-great-grandmother. And so when you receive cash inheritance, whether it's $16,000 or $16 million for the recipient, there's no tax consequence. So you don't need to worry about that. Now, if people inherit a home, they're not going to worry about paying income tax on that particular inheritance. But if they place the home into service as a rental property, then of course, then they have rental income. Okay, and then the next item, David and Ali are neither blind or disabled. If you are blind, if you have visual impairment and you meet that tax definition, you get an additional amount on your standard deduction. The next item, Sean, can you call on someone who's got the scenario in front of them?
How about Evelyn?
Are you with us, Evelyn?
All right, I'll try somebody else. How about Hal Matson? Do you have the scenario, Hal? Let me try Phil Shakurlian.
Hey guys.
Hey, Phil, do you have the scenario in front of you?
I'm sorry. I've been having trouble logging in, and I'm sorry. I actually had to take a quick call too, so I got
Okay.
lost.
All right, we'll go
Okay,
somebody
then,
else.
All right.
I will tackle this then, Sean. So I'm on the scenario page 2. The next item is Ali sends her mom $1,600 to help her mom buy medication and medical devices. Ali does not and cannot claim mom as an exemption. There's no entry that we need to make for that because mom is not an exemption, not a dependent, so we need to move on. The next item, it talks about the Wins took a fencing lesson, i.e. they've got swords or sabers or foils, and they're doing that to, it says unwind in the scenario. In the scenario, it says that some of the fencing equipment was stolen from Ollie's fencing locker, and Ollie had no insurance, and the property was not recovered. And so the consideration is, how do we treat that? And there is no consideration because for our purposes, casualty and death losses, we don't do that in the VITA program. And also, this is not a presidentially declared situation, so no consideration there. Next item, it talks about David, taxpayer husband. He still owes the IRS for a previous tax year, and he's paying on that debt, i.e. principal and interest. There is no consideration on the current tax return for that. The next item says Ali helped her friend start a business, and the friend plans on paying student. Let me restate that. Ali helped her friend start a business. The friend plans on paying Ali $4,950 for the work done. This payment is going to be made in December 2021. We're looking at a 2020 tax return. There's no consideration there, so you can ignore that. Okay, let's go ahead and go down to the Schedule C as in Charlie. That would be profit or loss for business. And if you have the scenario in front of you, we've got Ali. She's a self-employed tutor. And we're going to go to our Schedule C as in Charlie. So go ahead and hit continue if you would. And then a couple ways to get to it. We can go over to the federal section and click on that. And then we can go down, cursor down where it says profit or loss. Okay, this is for the wife, Ali. And she doesn't have a doing business as a DBA, so we leave all this stuff blank. And then for the business code, we can click on that. She is a self-employed tutor. And so we can cursor down and look for what is called education. And let's see if we can find that. There we go, educational services. All right, and so we've got that. We're good to go. We can hit continue. We're going to go to that top tab where it says, I stand corrected, be the second tab. Yeah, go ahead and either hit continue, go to the second tab, questions about the business. So you're going to leave the cash thing alone. That's all we do in VITA. Cash means you're going to report the income that you receive, and you're generally going to deduct the expenses that you paid. We're going to leave that cost thing for inventory. We don't do inventory in VITA, so just leave that alone. Material participation, you ask them, hey, are you involved in your business? Your clients are typically going to say yes, day to day on a regular basis. And that's what we're going to do there. So we're going to hit continue. We're going to go to the tab that talks about income. And this is really important if you're new or newer. If you've been around the block, you already know this. But you want to determine their total receipts. And some people are very good about accounting for their total receipts. I met other people, they look at you and say, I don't know. And so I tell them, well, you want to have a method, whatever method you want, but you want to have a method to account for your gross receipts. It's really important. So come up with a system. Maybe you should read IRS publication 334, but come up with a system. In this case, she had 30,000. 30,000. And she has nothing else, returns and allowances. That typically is going to be for a merchandising business. So we're going to ignore that. And we're going to hit continue. And then her list of expenses. And Sean's going to go down to general expenses. He'll indicate that we've got supplies of 3,000. We have a business license of $150. And you'll notice in the scenario, it says cell phone, business use only. So in this particular case, this individual has a cell phone that uses only, or she uses only for business. Probably the best way to do that is let's put that in other expenses. If you want to put in utilities, but yeah, let's do this, Sean. Let's go ahead and hit that bottom tab that says continue. And let's go to other expenses. And then let's put in that $500 cell phone. And again, it's business expense only. All right, $500, we'll hit continue. And then our next item, it says business miles. So we're going to go to vehicle expense, car and truck. And again, we only do the standard mileage thing in the VITA program. So her vehicle is a 2015 Chevy Go. And she placed it into service on January 2nd, 2020. And then it says in the scenario that she had 17,000 business miles. And this is really important. Sometimes the taxpayer has to reconstruct, but the taxpayer should have a method to determine their business miles. She's not employed, so she has 0 commuting miles. And then she has other miles of 5,000. And if you need a taxpayer that says, I'm all about business 24/7, in a very gentle way, you should look at them and you should say, everybody has a personal life. And so you're not going to have, if you have only one vehicle in your life, you're not going to have business miles only. You're going to have other miles. If you have a job, a W-2 job, you're also going to have commuting. But you should flatly reject that and says, no, that's, again, use kind language, be gentle, say, no, you got other miles. You go to the grocery store and buy food. You go buy shoes. You go to church. You go to Vegas to gamble. Everybody has a personal life. Okay, let's see. We need to continue this. The first item, check if you have another vehicle. And the scenario says, yep, they got another vehicle. David's got another vehicle. Was the vehicle available for off-duty? Sure, of course it is. Do you have evidence? Everybody has evidence. Their DMV, their gas receipts, changing a tire, everybody has evidence. Is it written? Yes, it's written on a piece of paper or it's written electronically. So I usually go check, 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 check. Hit continue. And then at the bottom of the scenario on page 2, it says she showed you canceled checks for estimated tax payments. And so what we're going to do, we're going to hit continue and get out of that. And then we're going to go to the left-hand side where it says payments and estimates. In the scenario, it says that she made payments to the federal government. So we're going to go to the federal estimated tax payments. And she only made 2 payments. And so she had a payment on June 15th of $300. And then she had a payment on September 15th of $300. And again, of course, if you're responsible for quarterly payments, typically you make payments 4 times during the year. We're going to hit continue, and she also made state payments to the Franchise Tax Board. So go to state. And in this case, she made a payment on June 15th for $150. And she made payment on September 15th for $150. Okay, so we're done there. I'll read the next item at the bottom. Yeah, California. At the bottom of page 2, it says Ali gave you a canceled check paid to the Orange County Court for $275. This was for a parking ticket she received in 2020 for parking in a handicap zone while visiting a client. That is not a deductible item. Fines are not deductible, and neither are those court costs. They're not deductible. Okay, next, if you can go ahead and go back to the income section or the federal section. David won a cash prize, and so we're going to go to the bottom of this page where it says less common income. Then we're going to go to other income not reported. And we're going to go add another income item.
Oh, sorry.
And we're going to enter $475 for David for a cash prize or prize. And then you want to remember, if the person did not receive a 1099 MISC, you always want to remember Internal Revenue Code Section 61. All income is considered part of gross income unless otherwise excluded. A cash prize is not excluded. So we're good to go there.
And that's the right amount, 475?
475, correct. Okay, the next one, I'll just read it. There's no entry. They belong to a local Elks Lodge. That's a fraternal organization. They pay dues. Those are not deductible. They only use the Elks for social stuff. And now we're going to go to the Schedule A as an alpha. So Sean's going to go back to itemized deductions. And we've got the wins had home mortgage interest, so he opens up itemized deductions. He goes to mortgage, interest, and expenses. And we go to mortgage interest reported on Form 1098. And then we're going to go to add interest and points. Yeah, someone made a point. The Elks have qualified charity funds. They absolutely do. So if you're making a contribution to the Elks National Foundation or one of their charitable organizations, you are correct. That's a charitable deduction. But if you're paying dues as a dues paying member to the Elks Lodge, that is not a deductible expense. Okay, back to mortgage interest. The bank is called First Trust Bank. They paid $7,000 to their bank on their loan. They also paid points to the tune of, let me see if I can find that here. I don't think I have points in this scenario. Okay, so we leave that blank. Hit continue. And then we're going to hit continue. And we go to real estate taxes. They paid a property tax bill of $2,300. So we enter that. So that takes care of their home and their points. And now we're going to go back to our charitable situation because we're going down the list. I'm on page 3 now in the scenario. And we're going to go to itemized deductions. And this would be what is called a non-cash contribution. So we go to charities, we go to non-cash, and in this case, he drove 5,200 miles for Let's Provide Clothing to All. So 5,200, the computer will work its magic, and so we're good to go. We can hit continue. Okay, next item, it says David donated 150 hours to Goodwill, and he figured his time is worth $45 an hour. You cannot take a deduction for time that you donate to a qualified charitable organization. The next one, it says Ali has AB negative blood type. She donates for the Red Cross. She donates her blood. And if you donate blood, you're a great person, but you cannot take a deduction for blood donation. If you drive to the hospital or drive to Red Cross, that would be medical. I'm sorry, charity. But no, you can't determine the value for your blood. No deduction. Next one, she won an art contest. So we're going to go to other income. And it says in the scenario, she won $5,100 in an art contest. So we're going to add that. This is for the wife. She won cash. And the amount was $5,100. 5100. And then in the scenario, it says 3 days later, she gave her sister, Ali gave her sister the $5,100 so Lisa could pay her rent. Ali's a nice person, but that is not a charitable contribution because Lisa is not a qualified charitable organization. Okay, next, we've got the Wins donating cash to another charity. So we're going to go to Itemized Deductions. We're going to go to Gifts to Charity. And this is a cash gift. We're going to add that cash contribution. And in this case, they donated to the Feed the Whales and Save the Children. And they donated cash.
Oh, too long.
Yeah, that's going to happen. You might have an organization that has a long name, so you type in as much as you can. And in this case, cash. And they made the donation on November 20th. And the amount that they donated was $2,800. Okay, so we can hit continue. We're good to go there. And now we're going to go to our next item. We're going to go to capital gains and losses. So Sean will go back to our federal section. And he will go down to the tab that says capital gains and losses. And we have one entry here. Ali sold some shares in a coffee company. So we're going to indicate Ali. And she sold 100 shares. And then the date that she purchased these shares, acquired the shares, was April 5th, 2017. Typically, it'll be on your 1099-B as in Bravo. And then she sold these shares on September 12th, 2020. And so the entries that he's making clearly indicate this is a long-term capital gain. Sold it for $4,600. There was a 1099-B as in Bravo that was issued that stated cost basis. That's typically going to be the case. And the cost is $1,200. Okay, so there's our entry there. And we can now hit continue. We're done with that. The next item on your scenario, it says Ali ran for city council. She paid a filing fee of $455 and borrowed money from the bank. There's no tax consideration there. That's something that you can't claim as an expense. The next item, it says David and Ali paid homeowners association on their personal residence of $1,200. That's not considered an item on a tax return. The next item, he paid a dental bill. So now we're going to go back to the Schedule A as an alpha for itemized deductions. It also says he did not have dental insurance, and so he paid out of pocket for medical and dental $1,900. And so what you can do, there you go, on that first tab where it says doctors and dentists, $1,900. Okay, we hit continue. We're done with that. Next item, it says David paid $890 for DMV registration. So we're going to go back to our Schedule A as an alpha, and we're going to go back to our taxes paid. And you can open that up with that little blue pencil. And then he's going to cursor down a little bit, keep going, slow. And right there, it says personal property car registration. He's going to plug in $890. And then hit continue. Next item says David was ticketed for driving his car without a valid registration, no valid driver's license, and no proof of insurance. He paid a fine of $800, which included court cost of $75. There's no tax consideration for that. David needs to get his act together, but he can't take a deduction. Next item, on page 4, it says David received golf clubs from his brother-in-law. And of course, his brother-in-law and David played golf together. And it says David checked with the golf course and was told the clubs he received were worth $950. That's called a gift to a recipient. And when we have our VITA clients that come in and say, I received a bona fide gift, there's no tax consequence to the recipient. They don't have to report that. Let's see here. Let's go ahead and hit continue. And let's see if we missed anything here. Okay, let's go down to insurance. Yeah, and there was a comment in the thing that $890, it is deductible. And what you do, you're going to look at your DMV fee. For the purposes of this presentation, it's a fully deductible item. Okay, next item, health insurance. And in this case, they do have health insurance. However, they're not on the marketplace. And so they're going to indicate no, they do not have covered California.
And this is where we'd get back to the California page if we missed it before.
Yeah, no, we're not going to do that today, but we will do this in a later session where we're going to actually enter the California return and we're going to make some changes. So when you do that, you'll be at the state return and we'll make those changes. So let's see here. Let's, in this particular case, let's see. Oh, hold on a second. Let me digest this real quick. I know I ran through this. Yeah, let's go ahead and make corrections. And let's see what questions it asks us. And we're going to spend plenty of time with California in not today, but in future sessions. So in this case, we're going to indicate the county. I think it was Scott who mentioned this, that you got to come back to it. Principal residence, yes, they're physical residents. Now this one right here, full minimum essential health care. This is under the Affordable Care Act. They do have it through the employer. They're not in covered California, but they have that insurance. The answer is yes. And it says, are you in the California marketplace, which is called Covered California? The answer is no.
I think that's all we need to do.
And I think that's it. So you can hit Exit California. And then you can hit, there you go. Okay, let's see if we can display the return. I think we've addressed all of the items on the scenario that I can think of. So let's go to the return here. Can you turn it to a PDF document, Sean? Is that possible?
I believe I can do that.
If you go to View Print Return, yeah. And it looks like I see something as the DMV license fee tax deductible. That means you go to DMV and you pay them whatever, 20 bucks, and you get your driver's license. The answer is no. And it's kind of like a fishing license, not deductible unless you are a professional fisher person. All right. Maybe print your return should generate
it does, but I have to do a new share because it comes up in a different window.
Okay. And so what we'll do is we'll just show you, we'll have a little time for some questions and we'll go through it. And then while he's setting this up, I will go ahead and send out the scenario for next Saturday, probably on Wednesday, give you a couple days to take a look at it. And then also the PowerPoint presentation. I'll send that to the leadership team at St. Killian's. And then while you're getting set up, if anybody wants to come up, you ask a question, I'll try to entertain your question.
Jerry, it's Paul Abrams calling.
Hey,
I know,
Paul.
yep, greetings. I tend, if a box is not mandatory, I tend to leave it blank. I noticed you filled it in on interest income on the address for the financial institution. Should I be filling in more boxes than I should usually do?
You know, Paul, that's a good point. If you can get through the scenario without entering data, yeah, why take those extra keystrokes? But what I'm familiar with is I'm familiar with electronically filing, and I get a lot of rejects. And so what I remember is I would enter the data for a 1099, and that would be the dollar amount of interest received and the EIN of the financial institution along with the mailing address. But if you can get past that scenario, and you know, that's great. No extra keystrokes. But that's what I remember about the 1099 INT. Okay, we have just a few more minutes, so let's go to the 1040. And let's just concentrate on our 1040. There you go. And so what happens is when you finally prepare a return, you're going to see something like this. Of course, we'll be looking at the 2021. And so a lot of times what will happen is your clients will ask you some basic questions. If you have time, which you should go over the very basics with your VITA client. But let's look at this, just a couple things to kind of refresh your memories. Box 1 is going to be your wages from your W-2 job. Interest income is going to be reported on box 2 Bravo. Your capital gains, that'll be reflected on line 7. And in this case, it's long-term capital gains, which will be taxed at a preferential rate. And then we've got item 10B as in Bravo, charitable contributions. And for 2021, it's up to 600, but we're looking at 2020, so it's 300. And then you can also look at line 13. That's a qualified business income deduction. It's 20% of your net income. And so you'll see that from time to time on your Schedule C VITA clients. And then you got your taxable income, which is calculated. Let's go to page 2. And you'll see the tax. Sometimes people say, hey, how'd you calculate that? And you say, well, the software did it. And the taxpayer says, well, okay, but how do you calculate it? You go to the instructions of the Form 1040, and there's a tax table at the back. You simply have to know taxable income and filing status. And then line 25 alpha, you've got the withholding. And then in this particular case, we've got the recovery rebate credit, which is calculated on line 30. So you can see all of the payments on line 33. And then, of course, the difference between the amount of the tax, which is on line 24, and the amount of the payments, which is line 33, is the difference, which is the refund in this case. And let's go to the next page. This is your adjustments. You can see Schedule C net income, the other income items that we indicated there. And then we do have what is called self-employment tax, and we also have 1/2 self-employment tax, and that's reflected on line 14, that 1/2 self-employment tax. How about the next page? Additional taxes. Typically for our VITA clients, you're going to see the other taxes, which would be self-employment tax. You might have a situation where you have excess advance premium tax credit repayment. That's on line 2, and that's for someone who's been in covered California and they were subsidized too much. And so you might see that on a return. So I think that kind of takes care of what we want to talk about today. We're running out of time, but Sean, if you have any questions that I can try to tackle, we can stay on the line for the next like 5 or 10 minutes.
All right, so going to go back. There's a few questions. Let's see. I think we've already addressed the only part of the vehicle tax that's deductible is the DMV license fee. The rest of it's not. Or right. There's a property tax portion that's and it indicates which part is tax deductible on the DMV statement.
Yeah, that's a good point. So just look at your DMV fee, your DMV bill, and then you should have a line that says this is the amount that may be tax deductible. So yeah, that's correct.
Then there's a question about gifts, that there is a limit on how much gifts if you receive. I believe it's now something like $11,500, and it becomes taxable.
No, discount that. When you're talking about gifts, we're talking about a recipient, someone who receives the gift. There is no limitation. You don't need to take any action. We don't do gift tax returns, so if someone is donating money to someone, that's a different animal. But the recipient, there's no limit. You can get $1 as a gift, or someone can give you $10 million as a recipient. You take no action. You spend the money, have fun.
All right, and then there's a comment that some of the check figures aren't matching the tax layer tax return.
You're correct, and we don't have time to tackle that, but what we will do next week, we'll have a lot more time, and we will tackle that.
All right. That is all the questions that I see.
All right, great. So next week, what we're going to do, we're going to talk about some of the credits. We will go through another scenario. The scenario will probably be about as involved as today, but we want to make sure we have sufficient time to talk about the scenario. We'd like to have we'd like to have people contribute, and then we will check our check figures for next week. All right. If that's it, Sean, I will wish everybody a great Saturday. There we go. This is what we're going to talk about next Saturday. Keep in mind for tax year 2021, your child and dependent care expense, that particular credit is going to be refundable. But for now, if the 2021 program is still clunky, we're going to rely on 2020. I have to check that out. But we'll talk about the credits, and we'll also give you a scenario to kind of challenge you in other areas, but we'll focus on the credits. For the education credits, I would recommend that you have the publication 970 available, which talks about both the American Opportunity Tax Credit and the Lifetime Learning Credit. All right, Sean, that's all I have.
All right, I just wanted to mention again to everybody that the St. Killian volunteers, we will be providing you information on Monday about where and when to pick up your books. People from other volunteer sites, I know Omid from the United Way made a comment in the chat earlier that he has both those books, the 4012 Pub and the Form 6744. If someone wants a copy of that and they can't get it from their site coordinator, they could go to the Orange County United Way on 18,012 Mitchell Street in Irvine and get a copy during the week. And that's it.
Okay, all right. Take care, everybody. Talk.
Thanks, guys.
All right.
Thank you, everyone.
Thanks, Jerry. Thanks, Sean.
Thank you.
Thank
Bye.
you.
Thank you.
Thank you very much.
All right, that's the end of the call, and we'll be posting the recording as soon as we get it up there.
Okay, hey, thanks, Sean. Great job.
Bye.
All right, bye-bye.